We got a couple more minutes to start, so I am going to sit quiet until we reach the top of the hour. Hi, everyone. Thank you for taking the time out of your busy day to join me, especially to talk about something that most may not find all that exciting, but I totally nerd out on it. So I'm here to provide you some valuable information. I am Kanisha Coleman. I am the owner of Coleman Tax, and it's a boutique tax firm that provides tax services and CFO services to small business owners. Our mission, our goal is to save you more money by lowering your tax liability. And we do that with effective tax planning. So I'm coming to you today to drop some gems and sort of an intro into tax planning. This is a foundational framework because, as you can imagine, tax planning is a whole big world. But I'm going to give you something to get you started and to at least start having the conversation and put you in the mind frame of thinking about how you can identify tax saving opportunities. So yeah, this is my first time using StreamYard. So I know I'm supposed to tell you that if you want your comments seen and you want me to know who you are, that you have to give StreamYard permission. And I think you can do that by going to streamyard.com/Facebook. You may have already done it because I know some presentations in the past has been done via StreamYard. I think once you do it once, I think you're good. But I know that you do have to give them permission for that. And I think there are also instructions in the caption below this live as well to be able to go ahead and do that. So let's go ahead and get started. If anyone have any comments or questions, whether you're here live or on a replay, just go ahead and drop them for me. And when we get close to the end, I will leave time for Q&A. And if they're dropped during the replay, I'll monitor it for some days after this, and I'll respond that way as well. So let's get to it. I'm excited about this. And I bet you all thought that you were done with tax, right? Because the first deadline just passed, July 15th, which was Wednesday. And you probably filed your tax and you're probably like, okay, I'm good till next year. Well, I want to change your mindset about tax, right? Tax is something that we should actually be thinking about throughout the year, because if there are any changes or modifications or just strategies and plans we want to put in place, we got to do that during the year, right? We can't wait until the year ends and then another compliance season comes up, because, just to challenge what most people think, there is very little you can do at tax time to save on taxes for that tax return. All right, there's a little something here and there, but not anything like majorly effective. You really had to have put the plan or strategy in place during the tax year that tax return relates to. So for example, next year, April 2021, hopefully next year, April, will be worlds different than what it is right now. But if you want to save money on that tax bill, you have to put that plan in place throughout this year, 2020. It has to be done. Most things needs to be done by the end of the year. So you got all the way up to December 31st, 11:59 p.m. So keep that in mind. If you want to really put some things in motion to lower that tax bill, it has to be done throughout the tax year and not at tax return time. So let's get into it. Okay. Hi, Liz. Thank you for joining. Can you do me a favor and let me know if you can hear me okay? You can give me like a 1 or a thumbs up, or just I want to make sure you can hear me and see the screen. Well, I guess if you can't hear me, you wouldn't even hear my request. But hopefully you can. Okay, so that's just my intro again. I own a firm. It's Coleman Tax, and our whole big thing is, we want to help small business owners save more of their money. Like, not to get into policy or politics or anything like that, but in my personal belief, I really believe small business owners are just lifting and holding the country up. And so I really want, and it's my mission, to make sure that you're using the tax law as much as you can to benefit you. From my experience servicing clients, they're not taking full advantage. And so they're overpaying in taxes drastically year after year. I mean, it's estimated that small business owners specifically are overpaying by the billions in taxes just because they're not, utilizing the tax law as much as they can. So I am here just to fill that gap. I am a CPA, I am an IRS enrolled agent, and I am a certified tax coach. So I want to take all of those experience that I've gained over, working 8 years with the IRS and in public accounting and in corporate America. Now it's time to use it for some good. And that's why I chose to service small business owners. What I'm going to be talking about, I'm going to approach it very, very high level, just because I don't want to distract you with all the technical aspects of the strategies. This presentation is to let you know, to bring awareness, let you know it's there, to spark something in your mind. So when you go look at your tax return that you just filed, or your financials or your projections, remember some things that I said, and hopefully that encourages you to kind of look for some tax saving strategies. But in no way am I going to get really, really technical, because I don't want to distract you from the higher level view of what tax planning really is. So you're in the right place if you're just tired of paying such high tax bills. I am sure you all catch the news and you're aware that really big corporations like Amazon and Walmart and all the tech companies, they pay very little in tax, okay? Versus the middle class or the small business owner, they pay a very, very high rate in taxes, okay? So if you're tired of that, as far as just paying such a high tax bill, you're in the right place. If you want to just keep more of your hard-earned money, because you work very, very hard, and then just to give a third of that away, and you probably don't know why, it's just, it beats up on the morale, and then, you have a hunch that you're overpaying in taxes, like you think something ain't right, but you don't know where to start, right? You don't know how to lower the taxes or what the strategies are. So hopefully you will get that from this presentation. This is a foundational tax planning framework, right? In no way, shape, or form can I, in the next 20 minutes, give you all the tax strategies. There are hundreds, literally hundreds. And then if you take each individual one, what we do as tax strategists is that we put the pieces together like little puzzles, and together the strategies as a plan, as a comprehensive plan, lowers the tax bill quite a bit. So this is going to be, like I said, a framework, but just please understand that in between these 5 frameworks, there are literally hundreds that fall within them. And I'm going to give you some today, but that's just the beginning. It is so much more out there, okay? So we're going to talk about entity structures, right? What entity structure are you housing your business in? We're going to talk about accounting methods, and that refers to how are you reporting money coming in and money going out. We're going to talk about maximizing deductions, which is a huge one. And then we'll talk about retirement planning and some advanced strategies, or we like to call them loopholes. Everything I'm going to talk about is legal too. So when you hear loophole, I know loophole kind of has like a negative connotation, but I would never, put you in harm's way or jeopardize your business or my license. So it's all legal. I want to have you paying the lowest tax legally possible. So for framework part 1, the entity structure, how your business is housed. So everybody, just in your mind, you don't have to tell me or say it out loud, in your mind, real quick, bam, do you know what your entity structure is? Don't go run and look at the tax return that you just filed on Wednesday or that you just filed an extension for on Wednesday. You should know that, like, bam, off the top of your head. You'd be surprised how many people I meet, like potential clients, and I say, so what's your entity structure? Because that'll get my brain turning to see kind of how, if there's some opportunity to save in taxes. And most of them don't know. Most of them do not know. So I want you guys to know. So here are the common entity structures, very high level. You have your sole proprietorship or your single member LLC. Those entity structures, they file on a Schedule C of your personal individual income tax return, which is the 1040. The multi-member LLC or the partnership files on a Form 1065. The shareholder corporation or the S corporation files on the Form 1120S, and the C corporation files on the 1120. So if you take nothing else away from this slide, just know, hey, always know your structure, know exactly what you are. So when a CPA or another accountant asks you, bam, right there, I'm an S corp, I'm a C corp, I'm a partnership, I'm a single member LLC. So here's some strategies around your entity structure. So the discussion around entity structure is most people, when they start their business, most sole proprietors, they are going to be sole proprietors or single member LLC, which from a tax perspective is the same thing, right? The LLC is just a legal shield that you get from your Secretary of State in the state that you reside in. But from a tax perspective, they are the same thing. And it's a great way to start out. But what you will soon notice, if you're not noticing already, that as you make more and more money in that LLC, you are going to be subject to not only federal income tax, but self-employment tax. And it's going to eat you up, right? The more and more your revenue climbs or your net income climbs, self-employment tax is going to be your enemy, because it's a second tier of tax added on to the federal income tax. And so when you notice that, you're going to start thinking, okay, is there a way I can mitigate that? And you're going to notice it right around when you get to maybe $40,000 of take home. So $40,000 in net income. If you are at that mark or higher, take a look at how much your self-employment tax is in addition to the federal income tax you pay. There are ways you can mitigate that, that level of self-employment tax. And it's going to be the same thing for the multi-member LLC and the partnership. The next step after those entities, most people go to the shareholder corporation. That's, almost common among small business owners. Because what happens when you turn into the shareholder corporation, what happens is you have to then become an employee of your business. And your business will pay you a wage and issue you a Form W-2. That way, and how that mitigates the self-employment tax is because then the business is paying half of that self-employment tax for you. And then they will take the other half from your W-2 wage. Any money after that is not subject to self-employment tax. So if you take a distribution from the shareholder corporation, that is going to be free of the self-employment tax, which can save you a ton of money. Now, one thing I want you to remember about the S corporation is that although it helps save on self-employment tax, when you're making a decision if you want to switch to the S corporation, keep in mind the other cost that comes along with it. And this is the step most of my clients forget that I inherit that already switched over. The S corporation has a separate tax filing responsibility. So once you get out of being an LLC or an LLC, you're no longer filing on Schedule C with the 1040. Now you have to file an 1120S. So now you have to pay for an 1120S, which a rate to prepare that tax return is much higher than the 1040. Now you have to pay payroll tax. The business does. And now the business has to prepare a payroll tax return. Then you have to have a payroll service to pay you your W-2 wage that you must have. And then you have to make sure that you're paying yourself a reasonable salary. And that number is not determined by you. Usually you want to outsource that to an accountant because they have ways to research the market to make sure you're paying yourself a comparable wage. What happens if you don't pay yourself a comparable wage? Well, if you're ever audited, the IRS will come in and recharacterize your salary. They'll either increase it and force you to pay more payroll tax on it. Some clients, some people I see, they try to pay themselves a very low salary and pay themselves a huge distribution because the distribution, again, comes free of self-employment tax. Well, it's not going to fly with the IRS. So you got to make sure as long as the wage you're paying yourself is reasonable, you'll be okay. The next step is the C corporation, which is ideal if you're retaining the profit in the business. The C corporation gets a bad rap because people say it's subject to double taxation, which it is. But that's only if you take the dividend. If you're not planning on taking money out of the C corporation and you leave it in because maybe you're paying yourself a high enough wage and you don't need to take a dividend, you're not subject to the double taxation. Remember, the C corporation is at one of the lowest tax rates it's ever been. It's at 21 flat tax, which is awesome, which may be lower than some of these other options here. So what I would say, if you're making a decision, you think you're at a point where, okay, I've outgrown the single member LLC, and you're looking at these other corporation options, you got to run the numbers. You got to run them and see and compare what the tax outcome will be. Framework part 2, and I'm going to speed up just a little bit because I do want to answer questions, and I don't want to just go over my time just out of respect for you guys. Part 2 of the framework is accounting method. So that's how you're reporting the ins and outs of your revenue. Just a brief primer in the case that, maybe you are unaware, but there are 2 methods, cash and accrual. The cash method, it records actual cash inflows and actual cash outflows. So if you didn't get any money in your hand or in your bank account, you don't have to report it. IRS ain't taxing you because you didn't really get it, right? And on the flip side, if you didn't actually pay that expense money out, you do not get the deduction. The other accounting method, the accrual method, that is you reporting your income as it's earned. So if you didn't actually get any cash, however, you earned it, you performed a service for a client or for someone, they just haven't paid you yet, you still have to report that and pay tax on it. And on the flip side, with the expenses, let's say you will record the expense when you incurred it, not necessarily when you paid the money, right? So you could have incurred it. Let's say you ordered something, they invoiced you, you haven't paid your bill yet, you still report that. For C corporations, it used to have been they could not be on the cash method if they was under a certain level of gross receipts, but the new tax law changed all that. C corporations can now elect to be on the cash method if their gross receipts for the prior 3 years averaged less than $25 million. But for all other entities, you can choose the cash method regardless of your gross receipts. Now, why do we care about accounting methods when it comes to tax? Because there's strategy in it. Just because of the way the money inflows and outflows and the rules about reporting are, you can kind of get really, really creative, right? So if you are on the accrual method right now, if you look at your accounts receivable or your AR, and it's exceeding your accounts payable, so what you owe other people, your AP, you may benefit from switching to the cash method because then you can defer being taxed on that income because after all, you didn't get it anyway. Under the cash method of accounting, you don't have to keep inventory. You have to under accrual. The cash method, you don't. And so for folks that out there that sell some type of product, tangible product, where you buy it in bulk and maybe you have inventory, you do not have to wait to deduct the price of the cost of that inventory. You can just deduct it all under the cash method. Now there are some other rules around that, but the main idea here is that you can take the deduction in the year that you buy it versus waiting until you sell it under the other method of accounting. The cash method allows you to defer income and accelerate expenses. So let's say you get to the end of the year and you're in a high income year, like, whoa, you made a ton of money, you're in tax, great, right? If you know you're gonna make certain purchases right after the new year, you can choose to do them in December to lower your taxes. You know you're gonna need it anyway. You know you're gonna make the purchase in January, February anyway. Maybe you want to look at what you're going to purchase for the whole first quarter of the next year. Maybe you want to make that purchase in December for next year so you can take the tax deduction. Or maybe someone is going to pay you some money because maybe you got some work scheduled to do for them. Maybe you want to hold off on that until the following year so you can tax on the income. So you can get creative with that. Long as you make sure you adhere to the December 31st, 11:59 p.m. You got to make sure it's done by then. And then there's a last point there about accrual basis. I'm going to breeze right over that. My recommendation here for most small businesses, cash method is the way to go. And I'll give you these slides after the presentation so you can look back and kind of digest things a little bit more on your own time. Framework part 3 is maximizing deductions. I can't stress this enough. I have met several people that do not take all the deductions they are entitled to for several reasons. Number one, they're just afraid of the IRS. Now, I worked for the IRS for 8 years as a revenue agent auditing tax returns. And there is no reason to be afraid of the IRS. If you are entitled to the deduction, take the deduction, right? Long as you have, obviously proof that you incurred it and paid it, and you have the business narrative around that, right? Regardless if it looks like a red flag or it looks odd, if you have substantiating documentation, that's a big word for proof. If you have proof and you have a narrative around that situation, take that deduction. The second reason that clients don't take these deductions are because they're not keeping accounting records, right? So you cannot deduct what you don't track. Can't report what you don't track. And so you got to keep accounting records, and it does not have to be anything, complex and sophisticated. It could be a basic bookkeeping template in Excel, or you can keep it in Google Docs, in the spreadsheet in Google Docs. You can use QuickBooks, Zero Way. There's a lot of really low price, very good options out there for cloud accounting software, but you got to use something. And when I say this, and I don't mean to offend anyone, but bank account statements, merchant account statements, PayPal is not accounting. You cannot depend on those. You can't depend on those accounts to keep good accounting records. Now, this here, I want to point out this middle bullet here, the second bullet. Your business is the best tax shelter there is. Because if you incur an expense and it is in any way, shape, or form tied to your business, tax deductible. Tax deductible right there. When you compare having enough business to being a W-2 wage earner, having a business from a tax perspective is by far has more tax opportunities and tax saving. And why is that? Because our government, Congress, they want to encourage business owning in the country because it helps the economy. It helps create jobs. And so that's why they offer these tax breaks for business owners. But we got to use them. We got to use them. If there's any doubt as to tax deductibility, I would say take it. There's no penalty in making a mistake and miscategorizing something. There may be interest, but there won't be a penalty for it. But still take it if you know you incurred it for your business. So like I said before, keep good accounting records. Know what you can deduct. Now, I'm not saying know all the tax rules, right? There's too many of them. But know that most of them are here to help you in deducting things. And just know the basic rules about what you can deduct. There's a 4-part test. If it's business related, ordinary, necessary, and just not super expensive, super lavish, you can deduct it. Some strategies around that. Always be thinking in terms of your business. Can you recharacterize a personal expense as a business expense? Let me give you just a quick example. If you and your husband, your family, or your wife or your spouse, your partner, you're going on vacation, can you turn that into a business trip? Is there something you can do wherever you're going that will aid you in your business? Is there a conference there? Is there a business meetup there? Is there a colleague you have in that city? Is there a client that you've been following and watching and you want to have an in-person coffee meetup? Something like that. But in an instant, that trip, maybe not all the cost for the entire trip, but a portion of that trip is now related to business that you can deduct on your business tax return. So think about that. Framework part 4 is retirement planning. I'm going to breeze right through this just because retirement planning, there's not a lot of nuances, but there are some things that, very technical things that you have to be mindful of. The idea for me putting it here is this is one of the most forgotten about areas among small business owners. Because when we're wage owners, our job does it for us, right? They'll contribute on our behalf. Even if we choose not to, they'll contribute, but then we contribute because then they say, hey, we'll match. So we do that. So that's how they kind of lure you. But when you're offering your own as a small business owner, it kind of slips the mind, right? So what I would say to this is pay your future self and not the government. The retirement planning plans for small business owners are extraordinary. And these are the 5 top ones. When you're a wage owner, what you can contribute in a year through your job or through a traditional IRA is very small compared to what you can contribute and deduct if you're a small business owner. So keep these in your toolkit when you're thinking about, okay, what can I do to lower the tax bill? Some of these plans have to be established by December 31st during the tax year, okay? But you have all the way into the subsequent year to make the tax deductible contribution. And we're talking about high limits, y'all. We're talking about up to like $57,000 for the year 2020. That's a lot of money. You can't contribute those amounts of money to, like if you're a wage owner, you can't contribute all of that money in one given year. So keep these in your toolkit. Like I said, normally these are, I've seen this with some clients before. Normally we're strategizing. Maybe they want to get the bill a little bit lower. So at the last minute, they'll say, oh, let's contribute a little more, just because you have all the way up until your extended tax due date to make the contribution. So these can be some last resource for you as well. And then here's our last framework. And this is my favorite because you can get really creative. So these are advanced tax strategies or loopholes. I didn't put loopholes in there because I didn't want to like put it on paper that I'm like loophole and then people think, oh, she's illegal. I don't want to think that at all. But these are the advanced tax strategies, which just involves a little more creativity. So the first one, and this is a very broad loaded bullet here, but just stay with me and just think about this. If your income has increased drastically and you're gonna get taxed, you're gonna get taxed on it. Just think to yourself, what can I do to yourself or to your accounting professional? What can I do to shift this income? Maybe from me to someone else in my family, like a child or a parent I'm taking care of. So that now it's off of my tax plate and onto theirs, but they're going to get taxed at a way lower tax rate. You're going to give them the money to take care of the parent anyway. You're going to give them to your child to take care of themselves, to take care of them anyway. Can we shift that? Think about that. Or can we recharacterize the income? So for example, there's a situation where if you have a capital, You can characterize income to be ordinary or passive. Passive income normally is from, you will see it from like rentals, because you have the rental, but you're not really like there at the rental doing anything actively every day. The rental is making money because someone is either using the equipment or living in the property. So it's called passive. Normally, if you have a passive loss, you can't take it against ordinary income. You got to have passive income. So is there some income you can characterize as passive to be able to take the loss? And there are strategies around how to do that. Or can you defer income, right? Can you hold off? You earn the income, but can you hold off on getting it so that maybe you can accept it when you're at a lower tax rate versus the very high tax rate that you're at? The next one is kind of the flip of it, right? Expense creation or acceleration. Expense creation, that's what we just talked about before. Can you turn, for example, can you turn a vacation you were just going on for family into a part of it being for business to be able to be tax deductible, right? Or expense acceleration, right? So, for example, depreciation, which is the wear and tear of equipment. Instead of taking it over 20, 39 years, can you take it over 3 or 5 years, or maybe all of it in 1 year? Can you shorten the time for you to realize those tax savings? The rest of these, I'm not going to go through all of them. I'm just going to hit my favorites because we're almost at the end here. One of my favorites is the Augusta strategy. The Augusta strategy allows you to self-rent your home to your business. So, for example, let's say you're having an event, right? You do your research and you realize, oh, well, in my area where I live, it costs maybe $5,000. Well, you know what? You can charge your business $5,000. Have that business in your home. You don't have to report the income on your personal tax return, but you can take the expense on your business tax return. The Augusta strategy allows you to do that up to 14 non-consecutive days a year. That has been a game changer for my clients, guys. But there are rules around there. So, don't take anything I say and just go do it. There are things that need to be in place for that strategy to work. Another one of my favorites is hiring your child. Hire your child. If that child is under a certain age, that child, and they're capable, right? They can't be too young, but they can't be too old either. But if they could sweep floors or clean up your home office, or you can pay them a reasonable wage, they will not get taxed on it because they're kids. If it's under the standard of $12,200 for this year, and you can take it as a deduction on your business tax return. I love that strategy. It's a very simple one to put in place. Keep these others in your toolkit. Keep these others in your toolkit. There are things that need to be in place for them to be effective and abide by the law, but they're all legal and totally allowable, and they have saved thousands on tax returns. So, I hope this has kind of revved you up a little bit into seeing that there are areas that you can go look at right now today, since we just completed a tax return deadline, and you can kind of see where you are and if there's some opportunity for tax savings, right? We're in the middle of the year. You can kind of foreshadow and project what your business is going to do. And so you can kind of plan for that now. Now you have talking points to take to your accounting or tax professional, right? To be able to say, okay, this is what I project as far as income. I know that has a tax implication. How can we mitigate a large increase in the tax bill, right? Hopefully, these strategies will optimize your tax and financial lives and just keep more of your hard-earned money. Guys, that's what I'm all about, is just saving money, keeping it for yourselves, whether you're going to invest in your business or your future self or your children or what have you. Long as you have it instead of the government. And I'm not anti-government at all, right? But I just think that if you are entitled to it, you should have it. right? We don't want to overpay anything. We want to pay exactly what we have to pay, not a penny more, right? So ask yourself, hey, are you paying the lowest amount of taxes legally possible? If you don't know that to be true, or if you have some doubts, or you just want reassurance, right? You just want reassurance. Let's chat. I'm offering a free strategy session for anybody that sees this webinar. I have not even offered this like to the public because I'm just coming off a tax season. And so my calendar is freeing up, and I haven't, like I said, I haven't opened my doors, to the public yet. This is just for this group. So if you want to take advantage of a free strategy session just to talk about tax strategy, and if there is any room for improvement in your profile, you can book a free 30-minute strategy session with me. There's the URL for it. It's also in the caption to the live. And yeah, we can go from there. I do see a couple of questions. I'll address those. So I see a question, what would you recommend for bookkeeping when starting out? Okay, so I would recommend that you start with an Excel spreadsheet, honestly. It does depend specifically on what you do, but if you have low volume transactions, let's say you have, 20 to 30 a month, I would start with a really, really good Excel spreadsheet. And I have one, and I can put that along with these slides. I'll attach it to the live, or put it in files somewhere on Facebook here for you. But what it does is it has a tab for each month. You put your expenses in, you put your income in. At the end of the spreadsheet, it would have built a P&L for you. So when tax season comes around, you have a spreadsheet already put together. You hand a whole spreadsheet to your tax professional and you're good to go. And so I will put that, I will give it to Evelyn, or I'll put it in the group files myself along with this slide deck for you. But I will start out with that. And if you are persistent on using a cloud, I love QuickBooks. That's all I've ever used. Most of my clients use QuickBooks. They are just the leader in their market, and in their field, and they're very cost efficient. And there are a lot of amazing automations that they have. Like I love that, like you could like snap a picture of your receipt, and they'll take the amount off, create the transaction in QuickBooks for you, and then keep your receipt. So, ain't nothing better than that. I just love technology. So toy with those two first before you invest a ton of money. Does amending taxes cause a red flag? Absolutely not. Nope. It is your legal right to be able to amend your tax return. The amending itself is not a red flag. It is what you are amending for. So it's not one thing, and I'm just speaking from like the revenue agent experience that I have. It's not one thing that's the red flag. It's the narrative behind the complete tax return that's the red flag. So we see somebody that amended a return, and then we look at the return and we see like, oh, they reported $50,000 first, but now they amended it and they're reporting $20,000 first. Let's see why. So then we go to the business part of the return, and we start looking like, oh, for some reason they have a whole bunch of expenses that they added to the business return. Let's see what these are. And then they're all like the we use this acronym LUQ in the IRS: large, unusual, and questionable, right? So is the expense large for what you do, given your income? Is it unusual for what you do and the overall scope of the return? And is it questionable? A lot of times, and I'll give you an example of a narrative that's a red flag. If you have a business owner, this is the most common one. You have a business owner that also has a full-time job. The business is always running a loss, and the loss is always offsetting the income and the tax earned from the W-2 job. That's a red flag. Now, can that be honestly true? Yes, it can. but the IRS is only going to allow it for so long before they realize, hey, you're just running a little hobby over here to decrease your full-time income. So it's all about the narrative. But does it immediately signal a red flag? No, not at all. So those are all the questions I see. Again, if you have any, feel free to drop them now or during the replay. I'll watch this thread for some days over the weekend, and I will comment as I can. I'll put this slide deck in the files. And I want to thank you all for joining me. I know tax isn't like an easy thing to talk about, but if there's one or two things you take away from today, number one, you're not done with tax when you file your tax return. Always be thinking about tax at least quarterly so that you can make the changes you need to save the money on taxes. Number two, there's nothing you can really do at tax time to save money. You got to do it during the tax year. So please, let's start to make it a habit of tax planning. Okay, thank you so much, guys. I hope you have a great weekend, and hopefully I'll be talking to some of you soon by during a strategy session. Again, it's eye-opening. So thanks a lot, guys.